You've been dreaming about buying your first property in Montreal, but you're not sure where to start. The year is 2025 now, and you've been wanting to do this, but you've been putting it off for a long time. Well, lucky for you, I've put together this amazing video where there's absolutely no fluff. It's just real life examples with a breakdown of what the costs are going to be for every single part of the transaction. We're going to go from the down payment all the way to the closing costs and everything in between. So you've been unsure how much it's going to cost and where to get started, this video is going to be a great place for you. My name is Aguinaga. I'm a real estate broker in Montreal, and I've helped over hundreds of buyers go through this process, and I'm very proud to say that we have over 200 5-star reviews on Google, so feel free to go check it out. Whether this is your first transaction or your 25th transaction, like for some of our clients, it doesn't change anything in the process. We're gonna go through the exact same steps every single time, and the costs are going to be pretty well the same. You're gonna see a couple variations in the examples we're gonna put through, and I'm also gonna give you an estimate as to what household income you will require in order to purchase a few different price points as we go through the island and we see what homes or condos look like in different parts of the island, all right? So without further ado, let's jump right into it. Let's start this off by discussing what are the costs involved in buying a property. Well, the first cost that everyone talks about is down payment. When you're buying a property, the minimum down payment that you can put down is 5% of the purchase price. Now, it's important to note that that 5% only applies to the portion below $500,000. If you were to buy a property that's above $500,000, then the segment above 500 grand, let's say you were to buy something for $750,000, that first 500K, you put 5% down. On the 250K from 500 to 750, you'd be putting 10% down, okay? So it is a tiered system. There are echelons that we kind of have to go up in this sense. But the first cost is down payment. We can put anywhere as much as we want. Technically, we could buy the property fully cash, means with no mortgage at all. But it's very common for people to try and get to the 20% down payment threshold, because when you do that, you get to avoid the mortgage insurance. Now, what is mortgage insurance? In Canada, because banks are very risk averse, what banks like to do is that whenever a buyer puts less than 20% down, they are required by law to take a mortgage insurance. In this case, this is a mortgage insurance that is underwritten by three main companies. You have CMHC, which is the most popular one because they're backed by Canada. We've got Sagen, and we've got Canada Guarantee. At the end of the day, all three of them do the exact same thing, and they charge pretty well the same thing. They have a couple of slight differences in the programs that they offer, but overall, it's the same products. Now, where do they make their money? Well, they're issuing an insurance policy, and depending on the amount of the down payment that you put down, they're about to charge you an insurance premium. So if we focus over here, we've got this section. If you put anywhere from 5 to 9.99% down, the premium is 4%. If you put from 10 to 14.99% down, the premium goes down to 3.1%. If you put from 15 to 19.99% down, that premium goes down to 2.8%. As you can see, the larger the down payment that you put, the lower the insurance premium becomes. This is because the more down payment you put, the less risky even the insurer seems to be considering the loan, because obviously the more you're willing to contribute, the more likely you are to honor your payments and not default on this property. As you can see on this sheet as well, that if you have 20% or more, we no longer have an insurance premium because we're no longer required to take on an insurer. We can really just go purchase price, less down payment, straight into our mortgage. Now, how does this work on a financial basis? Well, here I have another example. If you were to buy a property for $600, put that 10% down, that leaves us with a balance of $540,000. On this $540,000, because we put 10% down, we're gonna use a premium of 3.1%. In this case, that works out to $16,740. And that would mean that our final mortgage in this case would be $556,740. So that's what the bank's actually going to loan you. Now, let's take this a step further. How is this going to look like from a monthly perspective? Because it's very nice to see a large mortgage amount, but what does this mean on a monthly basis? Well, over here I have a sample scenario at 25-year amortization, 5% interest, and that means that the monthly mortgage on this property is going to be $3,238. Now, don't fret, the interest rates are currently a bit lower than that, and if you are a first-time buyer, we can even amortize as long as 30 years on an owner-occupant property if it's your first time, but nevertheless, this is just a scenario that we run, which is a pretty baseline one. After that, we have to consider a couple different things. Now, other monthly expenses that we're going to have in this case. You're going to have your property taxes. Now, although in Montreal, you actually pay them twice a year, not monthly, a lot of people prefer to budget their lives on a monthly basis because that's what we're used to budgeting on for everyday life. Therefore, I put a monthly calculation here. On this property, I have a sample rate of about $5,000 a year, which works out to about $458 a month. I would put that into my monthly budget. Then if this was a condo, we'd also have condo fees to consider. Right now in the Greater Montreal area, we've seen condo fees go up significantly because of a couple of recent law changes. The buildings have to do a lot more preparation, have to be a lot more generally prepared for upcoming costs. So we have what's called the asset management plan that buildings have had to put into place. We've had the insurance fund that has been put into place, and buildings overall just have to be a lot more prepared for upcoming costs because overall we have an older city and there's a lot of upcoming maintenance and costs with a lot of these properties. So I've got $400 a month in condo fees here. Again, this really will vary from building to building, but if you are seeing a building that has less than $200 a month in condo fees, chances are there's going to be a readjustment coming your way soon. The next thing to consider here is insurance. Now I have an insurance fee of $50 a month, so that works out to about $600 a year. That would really be for a condo in a larger tower. The second you get into, let's say, a condo in a duplex, triplex type of building, or if you have a single family home, that amount's going to go up. A single family home is probably going to cost you closer to $1,500, maybe $2,000 a year. So make sure you're budgeting properly for the type of property that you have in mind that you want to get. The next set of costs that I want to break down for you. Now we have the closing costs. So this section over here. Closing costs are costs that we see one time whenever we are purchasing a property, but as you're about to see, they're pretty significant costs. Let me walk you through them one by one so you can understand how this is going to go. The first cost is the inspection. At the inspection, we're going to hire a professional inspector to come in and verify the entire property. They're going to give us a good idea of what the current state of the property is. Now, it's important to note that that's not a warranty on the property. It's simply an inspection report that a certified inspector has prepared that'll give you a visual representation of the property on the day that it was inspected. With this, we're gonna have a pretty good idea what to expect coming down the line in the next couple of years in terms of plumbing, electrical, foundation, roofing, structure, windows, you name it. Effectively, we tell our clients that this is gonna be a report that you're gonna be able to refer back to so that you know what the upcoming work on the property is and how to work with it. What's this going to cost you? Well, it's gonna depend on the property type. If you are buying, let's say, a condo in a larger tower, you're probably looking at about $550 for the inspection. If you're looking at a condo and maybe a duplex triplex, it'll probably be closer to $750 to $800. If you are looking for a large single family home, let's say over 2,500 square feet, that might be $1,000. And if you're looking at a multiplex that's maybe 3, 4, 5, even 6 units, well, the price might go up to $1,200, $1,300, $1,400. It really depends. I'll also take the opportunity here to recommend that you're probably going to want to have your plumbing drains scoped with a camera, depending on the age of the property and depending if they've been replaced recently or not. If we don't have any information on them, this is a good time to do that camera scope inspection, and that's probably going to run you about $450 to $500. With this, we're going to understand what condition the main drains of the property are in. Next fee in the closing costs, we're going to have notary costs. So right over here, notary is the one who's going to take care of the legal side of the entire transaction. They're going to make sure the property you buy is completely debt-free. So they're going to pay any existing loans and liens on the property. They're also going to ensure that the seller is really the right person to be selling you the property. As trivial as that may sound, sometimes with succession, so people passing away or divorces and whatnot, some of the paperwork wasn't done properly, and we want to make sure that you avoid any problems down the road. So because of that, the notary will make sure that everything is in check and in order, and any problems that need to be rectified before the transaction will be rectified, so you have absolutely nothing to worry about later on. For their services, they are, at the end of the day, lawyers. They're going to charge us a fee. So depending on the type of transaction, depending on the notary firm, larger firms tend to charge a little bit more. There's going to be a range of prices. It's also the complexity of transaction plays a role in this. So I like to tell people it's anywhere between $750 to $2,500. I'd say on average lately in 2025, we're seeing $2,000 be that magic number what most notaries are charging our clients right now. Next on the list, we have adjustments. Adjustments, simply put, are a reimbursement of prepaid expenses that have already been paid or prepaid revenues. What I mean by this is that earlier on, I mentioned that taxes are paid twice a year. In Montreal, for example, municipal taxes are paid in March and in June. That means that if we notarize sometime in April, the taxes have already been paid all the way to the end of June because it covers Jan 1 to June 30th and then July 1 to December 31st. We're going to have to refund the seller the portion of taxes that they have prepaid that they are no longer responsible for because they will no longer be the owners of the property. The notary is going to say, okay, today's August 15th, there's exactly this many days left until June 30th. He's going to divide by 365, he's going to multiply it out, and he's going to give us a clear number for what we owe the seller. And the reimbursement of pre-received revenues that I was mentioning, if you're buying, let's say, a triplex and the property is fully rented and the landlord collected the rent on the 1st of the month, as is the common way of doing things. Well then, if we buy that property on the 15th of the month, like I just mentioned, then the landlord already collected the rent all the way into the 30th. He owes you the rent from the 15th until the 30th. The notary is going to adjust that in your favor. So over here, I put a placeholder of $2,750. Realistically, what I like to tell people is that just assume it's going to be roughly half of your taxes. Generally speaking, that's going to be the most the adjustments might be. It's usually less than that, but I rather you budget appropriately and conservatively so that we don't have any surprises down the road. Next on our list, we have the CMHC tax, and you see a 9% next to that. That's right over here. Earlier on in this presentation, we spoke about this lovely CMHC premium or insurance policy that we took that cost $16,740. In Quebec, every single insurance policy is subject to a 9% tax. So that's where that 9% comes from, and that's where this $1,506 comes from. That's 9% of that $16,000 that I mentioned just above. So depending on what your premium or what your insurance policy is going to cost on this, you're going to have to factor in the taxes. Over here, I mentioned that you're going to get a mortgage for that entire amount. So that part you're going to be able to finance, but the tax portion you cannot finance. You're going to have that ready to go on the day of the notary is when that's going to be charged to you. Next, we have everyone's favorite welcome tax or land transfer tax. Okay, mutation tax is another word for this. Effectively, whenever you move into a new city, neighborhood, and even if you already live in it, whenever you buy a property, the city is going to send you a tax bill, which is the Welcome to the Neighborhood tax bill. And it's calculated on the higher of the sale price or the municipal valuation. So just because you got a really good deal on the purchase price, if the property was evaluated for a higher amount from the city, then you're gonna have to pay the welcome tax on that higher amount. It's important to note that because a lot of people forget about that and then they get surprised when they see their actual welcome tax bill. This bill is payable in one shot. You technically have 30 days to pay it from the time of reception, or actually the date of issue. So make sure that you check the invoice, what date it was issued. Sometimes it takes up to a week to receive. And generally speaking, the cities like to get it to you within 30 to 60 days following the transaction. I have seen it take longer, but I would expect it to be 30 to 60 days. If it's been 4 or 5 months and you haven't received it, I highly recommend you contact the city to check in on, make sure that they haven't sent it yet or that it hasn't gotten lost in the mail, because you're gonna be the one who's responsible for interest and penalties if you have not paid it when it's due. So this is a breakdown of the cost that we're gonna see. Now, I wanna take us over into what it's gonna look like when buying a property. And I have a calculator to show this to you. So let's take a look now. Let's look at some real life examples now. So let's start off with the Sud-Ouest, which is a trendy area that's near the canal that has a great mix of condos and plexes. You even have a couple of single family homes in the area. You can expect to pay anywhere between $550,000 to $750,000 depending on the type of the property, but let's see what we can find. I'm gonna focus on condos right now. So I'm gonna go Montreal, let's go into the Sud-Ouest. Let's look at Little Burgundy, St. Henry, and Point St. Charles under, let's say, $775, at least 2 bedrooms. Let's say we want a parking spot, a garage. I've got 25 matches available right now, and let's say we want it to be at least 1,000 square feet. We've got 4 matches. Okay, let's see what we're looking at here. So we've got this apartment on Bourgeois, another one on Island, and St. Ambroise. You know what, let's take a look at this one on St. Ambroise. It's a 2 bedroom, 1 bathroom, pardon me. So we've got this unit over here. This is right on the canal. It's a nice unit, as you can see. I think we see some snow out there, but $750. You have 1,143 square feet. Condo fees are $570. Taxes are $48.52. So you know what? Let's see what it would cost us to actually purchase this property on a couple different styles. Okay, so if I were to take this purchase price of $750, and we're gonna use a 10% down payment, that's $75,000. I've got the CMHC fee here of 3.1% or $20,925. We just mentioned that we have $48.52 in annual taxes, and then we're going to have roughly $68.40 in condo fees. So is equal to $68.40 plus, let's say $600 a year in insurance. And we just said that it would be $48.52. Okay, I've put this on 30 years, so I'm assuming you're a first-time buyer, but I can actually even put it on 25 years if you want to be more conservative. I have a rate of 4%, which is roughly where rates are at today, and we're gonna run this as 2 different examples. So in scenario 1, your monthly costs are gonna be as high as $4,685 for this property. Now, if I do put this on 30 years because you are a first-time buyer, then all of a sudden they come down to $4,333. Now, what were to happen if we were to put 20% down on this property? So 20% down, so we've got $750, that's a down payment of $150, which means we're gonna finance $600,000. The taxes don't change, the insurance and the condo fees don't change on the property. I'm gonna amortize on 30 years because I usually like recommending that. Again, depends on your financial situation, but if you are buying your first property, you usually want to lower the monthly cost as much as possible up front. And once you're more stabilized in a property, then you can reduce the amortization if you'd like. Whenever you do go conventional or put 20% down or more, the interest rate is a little bit higher. So here we've got 20 basis points higher. So that's why this is 4.2 versus the 4% that we have over here. So in this case, the monthly is actually gonna be $3,945. Now, it's really interesting to note here that this change only happened at the end of last year. Before that, the most we could do here is gonna be 25. And here we see a very significant change, right? When you're amortizing on 25 years with 10% down or 30 years with 20% down, we're talking about a $739 swing from one scenario to the other, okay? Now, let's take a look a little bit further here. In scenario one, total cash invested is about $92,000. All I did over here is I took your down payment and I added some closing costs that we have over here. In scenario two, your total cash is going to be higher. Now, you'd have to remove the CMHC tax because you don't have it in this scenario. The formula doesn't do it automatically, but it gives you an idea of what we're looking at here. Over here, we have the qualification portion that I mentioned I would talk about. So in this video, you're gonna see what's called a stress test. Over here, we've got a 6% stress test. And the reason why this 6% is because the current stress test is at least 2% higher than the interest rate that you're being quoted at the time, with a minimum stress test of 5.25% if the interest rates fall below 3.25. So that's not the case right now with the interest rate of 4% that I mentioned, plus 2 gives us that 6% over here. Now, if I apply that 6% over here to the monthly mortgage, it's gonna end up being about $4,453. I bring in the same tax amount as before, the same condo fee insurance amount as before. That gives me a total monthly cost of $5,477. Annualized, the cost on this property is gonna be $65,723. We have two different types of ratios whenever we're looking to buy a property. We have what's called our GDS ratio or our TDS ratio. For the sake of this, I'm simply gonna focus on our TDS ratio, which has to be below 40%. So what I did here is I took this and I divided it by 0.4, which is the same thing as 40% in this case. And that means that your income required would have to be at least $163,307 in order to qualify for this property. Now, it's important to note that in this case, I'm assuming that the person has zero debt and no monthly car payments. This assumes absolutely no other monthly obligations. So if you do have a car payment in there, or if you do have some credit card debt or some student loan debts, or even a line of credit that's currently has a balance on it, you're gonna have to add those amounts. But in this example of assuming you have no debt, no monthly car payments, then you would be able to qualify for this purchase with an income of $164,307. As we move down, if you did have the 20% to put down to the property, we would be financing a slightly lower amount. Again, I use the 2% higher than the 4.2 here. Your monthly mortgage would end up being $3,644. In this case, then we have taxes and insurance which don't change. All of a sudden, our annual amount due is gonna be $56,000 in this case. If I divide that by the same 40% that I did just before, that means that the income required here would be $140,000. So because our monthly costs are going to be lower, it's going to require a lower annual income to qualify. Again, this has absolutely no other debts considered into it. So it's a pretty basic calculator, but it helps give you some perspective on how you could get into a property. Another thing that a lot of people ask is, well, do I have to earn that much on my own? And the answer is, well, it depends if you're buying the property on your own or if you're gonna be buying with a spouse, a partner, a friend, whatever it might be. If two people are buying, then it's the combined incomes. So if one person makes 100 grand, the other person makes $80,000, all of a sudden your household income, as they call it, is $180,000, then in both of these cases, you would qualify. It really depends on who's gonna be on title, who's purchasing this property that you can use. You can also potentially get a guarantor or a co-signer to help you buy a property depending on your situation. So this breaks down what the qualification looks like and what the monthly cost would look like of buying the condo that we just saw here in St. Henry for $750,000. So now we saw what it looks like to buy property in the Sud-Ouest area. Now let's do the exact same search, but let's move on over to the Plateau, for example. So if I were to go to the Plateau, let's use similar criteria, but let's maybe see if we can get something for a little bit less. We're gonna go with $650, for example, but I'm gonna remove the garage because parkings in the Plateau is very, very difficult to come by. So as you can see, I've now got 27 options, all with 1,000 square feet or more. So we're gonna run the exact same scenario. So we've got this one on Aylmer. Let's see. Let's say we wanna live in a specific area of the Plateau. So this one on Montana seems like it could be interesting. 627, right near the park over here. Let's check it out. So this is a divided condo. You're gonna own 16.66% of the entire building. You're looking at 1,100 square feet. Taxes are just over $4,000 a year. Condo fees are about $400 a month. They seem to have done quite a bit of work to this property in terms of renovations, the kitchen, the flooring, the plumbing, the bathroom. Let's take a quick look. Oh yeah, nice unit, fully renovated. Very cool. Okay, let's take a look at this. So $627 is the purchase price on this one, and let's do the same scenario that we just did in the Sud-Ouest. So let's say we're to buy this property for $620,000. We negotiated $7,000 off of it. We just said that the taxes are looking like they're going to be $4,068 and $4,800 for condo fees. So $4,068, and here we're gonna go $4,800 plus the same $600 that we had just before. Let's amortize this on 30 years. Why not? You're a first-time buyer. And now it's looking like our total monthly costs are gonna be $3,525 a month. If we were to put 20% down, that number is going to go down to $3,204. Again, 30 years is what we're assuming here on both. And then in terms of qualification amounts, well, now you'd need $126,000 to qualify if you were buying this property with 10% down. Or if you're buying it with 20% down, that number would go down to $114,000 in income. All right, so now let's look at a couple examples under $500,000 so I can show you what it looks like to purchase a property with only 5% down. Now again, please note that you can buy a property with less than 10% down, even if it's more than $500,000. It's just you have to put 10% down on the spread above $500,000. So let's see if we have any examples here. We've got this option here on Papineau. Let's see, $499,000, the 2-bedroom, 1-bath, 1,152 square feet. Let's price this one out. So if we were to assume we were to pick this property up for, let's say, $490,000, and we'll put 5% down. We've got taxes of $34.43, condo fees of $125. That is low. Again, like I mentioned earlier, that's something that I would look to see if it's realistic or if it's going to be going up in the near future, especially for a property that was built in 1910. I would have my doubts about that. So let's put this in, $34.43, $1,500. So as we look at this property over here, your monthly carrying costs are gonna be about $2,764. And then if we were to put 20% down, you'd be looking at $2,370. So we've got a spread of $3,893 on one versus the other. So that's 5% versus 20%. As you can see here, the CMHC premium went up to 4%. And then over here in terms of qualification, well, qualification, if you were to put 5% down, you'd be looking at just over $100,000 in income required. And qualification, if you were to be putting 20% down, you would need just over $85,000 in order to qualify for this purchase. So it gives you an idea, it gives you an idea of the ranges that you would need for one versus the other. Plateau is an area that is in very high demand. A lot of people love the Plateau because of all the coffee shops and kind of the quality of life you can get over there. So here we are, we're looking at the map of Montreal. So the first property we looked at was in the Sud-Ouest area. We looked at St. Henry, Little Burgundy, Point St. Charles, and we have this area near the canal over here, which is in high demand. And that very first property was 4200 St. Ambroise, which is right around here, just after the train tracks actually. And now the next area that we looked at was the Plateau, which is this area over here, which is kind of in the heart of the city. And like I mentioned, there's tons of coffee shops, great restaurants in there, great for biking, very walkable. You have La Fontaine Park, access to the Mount Royal as well. Why don't we head over to the West Island now? So it's called the West Island because it's in the western part of the island. We've got Didio, Pierrefonds, Pointe-Claire, Dorval, Kirkland, Beaconsfield, Baie-d'Urfé, Senneville, all this. And let's see what a house in that area would cost us. Single family homes in this area are a little bit more expensive, but let's see what we can do. So let's go search single family, go Montreal, let's see Didio, Beaconsfield, Kirkland, Pointe-Claire. Let's start with that. And let's see a home. A lot of the average prices in the West Island right now, I'd say about $750 to $800 for a nice home. There are some that are less expensive. Obviously, we can still get into a single family home. So let's see what we can get for under $800,000. And let's say we want at least 3 bedrooms upstairs. We want a garage, 2 bathrooms. It's been pretty popular ask for a lot of people. And let's say we ask for a detached property because if we're going to the West, we want a detached home. Let's start with that. So that gives us 39 results right now. Oh, so we got a nice variety of properties. Let's say we were to look for a home that, let's see what has the most bedrooms. Let's sort by bedrooms now. Oh, we've got this one on Assimilative Living that claims to have 5 bedrooms. This is a large property, $675. So yeah, classic split level on Assimilative Living, which is somewhat of a passing street in the West Island. So let's build this one out. So here we're at $675. Let's say we're to pay $670 for the property. Let's say we were to put 10% down in this scenario. We're looking at $56.24 in taxes. Now in this case, we no longer have condo fees, so I can delete that, but my insurance bill is gonna go up. So let's say we're gonna pay about $1,750 a year in insurance. And now we've got our scenario here. So now it's gonna cost you about $35.70 if you were to buy this with 10% down, or if you were to put 20% down, that number goes down to $32.24. So that's a difference of $346 a month, depending on the down payment. So obviously, when you look at it this way, it might make sense to put that smaller down payment, especially if you're a first-time buyer and you can amortize on that 30 years. If you are not a first-time buyer and you have to amortize over 25 years, now the difference is a lot more significant at $660 per month. We look at it over here in total cash invested. Now again, like I mentioned, this is your down payment plus some of the closing costs. Obviously, this is significantly larger because it's twice the down payment that we're going to be looking at in this case. And then to purchase the property, well, $137 in this scenario versus $116 in this scenario. So let's say we were to go a little bit higher price. So let's see what a more expensive property would look like here. So I'll go back to my partial display. Let's sort this by price on the high end now. So we've got this one on Jourdain Street that's asking $799. All right, so let's say we were to pick this property up for $790 and taxes here are $53.36. So $790, $53.36. Let's make our insurance about $2,000 because the property is a bit more expensive. Now your monthly 10% down, 25-year amortization is $4,467 versus with the 20% down is $3,688. The difference between those two numbers is $778, so a very large difference now. And to qualify, you need to earn about $159,000 if you're putting 10% down, or $133,000 if you're putting the 20% down. Now again, as I had mentioned, you can do this, it's a household income or the buyer's income, right? It can be a combination of people, so no stress on that front. Now let's see what Laval is looking like. So in Laval, let's go with Chomedy, Laval de Rapide, two of the more popular neighborhoods. 800 grand, same budget. Yeah, same specs as the West Island because they're usually pretty comparable. A lot of people who want to live in the West Island would be open to living in Laval. The biggest driver between those two is metro access, so that might change now that we're going to have the REM coming to the West Island shortly. But historically, because Laval got the metro access about 20 years ago, that really pushed people in that direction. It might be a little bit less than 20 years ago, but nevertheless, it's been a while now. So again, a lot of prices in that upper echelon of pricing. So I won't go through the example here because the prices, I mean, as you can see, it's gonna be very similar. The other thing that we haven't put into the budget right now is that you wanna consider maintenance costs, snow removal, landscaping, all that kind of stuff in your budget. So you do wanna have an additional line item for that. I'm just not putting it because it's not a forced payment that you're gonna have every single month, but you do wanna consider that when you're building out a pro forma of costs for your budget. If we look at, let's say, this one over here on Darvaux Street, split level property, taxes are a little bit lower here. We're at $42.53, 3+1 beds, 2 bathrooms, 1 garage. Did a couple of renovations to it recently. Nice modern interior. Heading back to the map, so that was in Laval, so that's this area over here. And I selected Chomedy and St. Dorothy, which are these two areas right over here. Let's head over to Vaudreuil right now. Let's look at an example over there. That's in the Montérégie. Let's head over to Vaudreuil-Dorion. Same idea. Now, what's cool is that if we go to Vaudreuil, we're gonna start seeing some younger properties realistically. So if I go results, partial display, I'm gonna add a little segment here. Let's see, geraniums. So this property was built in 2008, so it's a lot younger than some of the houses that we saw in Laval and in the West Island. $799. This house looks a little bit bigger than some of the ones that we saw comparatively. 2008 is approaching 20 years old now, but it's still a younger home, especially in the greater Montreal area compared to what we're used to. So if I were to price this out, again, it's gonna be very similar. It's $799, taxes are $44.72, $44.72. Now again, because of the value, insurance can be roughly the same. The numbers end up being very, very similar to what we just saw, so I won't walk you through that exactly right now for the sake of time. And now let's take a look at a home in Brossard. Let's head over to the South Shore, also in the Montérégie area. So now that we're in Brossard, again, we can obviously sort by prices. We can see that things are a bit all over the place. And you'll notice that the suburbs all have similar price points for similar properties, right? Vaudreuil being the one that has the newer properties for a similar price point. You can also even get detached homes, although a little bit smaller, for even the $550,000, $600,000 range. Brossard, the West Island, Laval all have very similar price points, very similar products. The advantage to Brossard is that you have 10-30, which is a huge shopping center, tons of restaurants, very popular area. You also have REM access, they have a station right there, and you have direct bridge access. So without traffic, Brossard to downtown could be as little as 18 minutes, if you will. With traffic, obviously, that number goes up to about an hour. So it shows you a couple different things. And on the map quickly, Brossard is right over here. Downtown is right over here. So it is a pretty short way if there is no traffic. But again, because you're limited by the bridges, you can get stuck in traffic on those bridges. So if we look at properties now, I mean, we do have one here for $639. Let's see this house. It's a bungalow. Living area is $1,252. That's gonna be the main floor, and then there's gonna be a full basement typically underneath that. Some of that space can be lost to the garage. Nevertheless, $639. I mean, look, I'll price this one out. Let's see if we're to pick this up for $630. Taxes are super low here, $28.94. And again, this is always refers to the municipal assessment. It's always gonna be a percentage of the municipal assessment. In this case, the municipal assessment was $587, and this is what our taxes look like. So let me put that in, $28.94. And let's go back to about $1,500 actually in insurance on this. So now we're looking at about $34.41 if we were to purchase this property for $630,000. And if we were, that's with 10% down. And if we were to put 20% down, this is now $28.20 over here. $621 difference. And again, if you are a first-time buyer and you can amortize over 30 years with that 10% down, now you're paying $31.45. So that difference is now only $325 a month. And if we shift our focus over here to the qualification, with 10% down, you'd need to earn at least $115,000 per year. With 20, you're looking at least 102. Again, little disclaimer, this is assuming absolutely no debts, no monthly payments, so no car payments, no credit cards, line of credit, student debt, etc. So very important to keep that in mind. So now I've walked you through a couple different areas of Montreal, what prices are gonna look like. One other thing I wanna show you is that depending on what neighborhood you're at, the welcome tax is gonna be different. So in my calculator that you saw over here, I always just have Montreal as a baseline, but every municipality technically has the right to charge whatever they want. So if we were to look at a purchase price of, let's say, $750,000, in Montreal, that land transfer tax is gonna be $11,000. If I now put Laval, for example, that goes down to $9,750. Let's see what happens if I put Mount Royal. That's back to $11,000 like we just saw. And if we go to Vaudreuil, $9,750. As you can see so far, Montreal has been a little bit more expensive than the rest of them. Let's see what Brossard is looking like, just to give you context on some of the properties that we saw today. Also $9,750. So right now, Montreal seems to be the more expensive municipality for welcome checks. So this is one more thing that I want you to consider when making your purchases and budgeting. So that pretty well wraps up today's video. I hope you got a lot of value. I hope you understand now better what it entails to actually purchase a property. What do the costs look like? I know this has been one of my longer videos, but there's a lot of value, a lot of content in here. I also didn't even have an opportunity to talk about some of the preferred savings accounts to get you to where you want to go, like the FHSA or the home buyer's plan. I do have other videos with that information, so feel free to take a look at those. We'll link them in the comment section below. But if you did get any value out of this video, imagine what it would be like working with myself and my team. This is the type of stuff that we do with our clients every single day to make sure that they are as prepared as possible so that they have all the information they need going into the largest purchase of their lives. If you did get any value, but you're not ready to make a decision this year, you're not ready to start working with us, then just give us a like, subscribe to the channel for more videos just like this. Thank you so much for watching, and I look forward to seeing you on the next video. Have a good one.